By 2030, Australia's superannuation system is forecast to be managing more than $5 trillion of accumulated savings on behalf of workers. Now, with that scale comes incredible responsibility and not a few challenges. To talk about the expansive role of superannuation, both within markets and also within Australian communities, please welcome your moderator for this session, Yasser El-Ansari, who, as you know, is the Chief Executive of the Australian Investment Council. Please welcome Yasser.
Great to be with you all, and can I ask my fellow panellists please to come up on stage now and join me, and we'll get this session underway. So I'm very lucky this morning to be joined by about $300 billion of capital, but it actually takes the form of 3 individual people, which is much better because talking to a pile of money is sort of a one-way discussion. But Deanne Stewart is the CEO, of course, of First State Super. And I'm joined also on this panel by Sam Cecilia, the Chief Investment Officer of Host Plus, and Sean Manuel, the Senior Portfolio Manager for Equities at Australian Super. So thank you, Sean, Sam and Deanne, for being a part of the discussion. This is going to be a really interesting chat because we've got a variety of perspectives that we want to talk a little bit about. I'm really keen to explore some of the insights that I'm sure all of you will be willing to share with this audience, this industry, around the challenges that confront superannuation funds here in Australia. As Ali said, we all know the scale of the super system is significant, to say the least. Talking about numbers like $5 trillion, $300 billion represented in this conversation alone at this point in time today, they are big numbers. So the first question that I want to talk to with the 3 of you is whether or not the superannuation system, sitting at $3 trillion or so at the moment, is it growing too quickly, Deanne?
I don't think it's growing too quickly. I think what you're actually seeing is, if I take a step back, I say, well, actually, we have created a world-class pension system here in Australia, and it's easy to forget that when you can focus in on some of the issues. I think what you're actually seeing now is the next phase of the superannuation system and the maturing of that. And so I wouldn't say that it's necessarily growing too fast. In fact, some funds are growing quite rapidly and other funds are shrinking. So you're actually seeing a fair bit of consolidation happening in the industry. And I think it's the industry really getting ready for the next phase. And I think what you'll see through that is pretty significant consolidation and a real maturing and sophistication of the system. And that's certainly, I mean, you just need to step outside of Australia and talk to those from an international perspective, and that's certainly how they're looking at Australia and seeing it with very much that lens.
Sam, has the growth in the system been matched by that sophistication, the increase in capability, the resource base that large pension funds like the 3 of those on this panel need to in order to be able to deal with and manage and deploy as stewards that pile of capital?
Yeah, I think that's the challenge. So we need to make sure that the capabilities that we have internally and externally match the assets that are available. But could I just address, if I can, the previous question from an investment perspective?
Sure.
The world's a big place, right? And there is an infinite number of assets to invest in. And the reason there's an infinite number of assets to invest in is because we can create assets. We can create buildings, we can create infrastructure assets, right? And so you can create your own supply. And at that rate, you can just keep building and keep creating and keep inventing and keep investing to do those things.
Yeah, and that's a conversation that I do want to spend a little bit of time on in this discussion. Sean, a question to you. Australian Super is the biggest of the domestic pension funds. You're sitting at, I think you mentioned a little bit earlier, around about $170 billion, I'm sorry. And so clearly with that you guys are not just at the top of the tree when it comes to that pooled capital base, but you're also seemingly going out into the market and doing some innovative things. And of course, it wouldn't be right in a discussion in this context to not address perhaps the conversation that many of you in the room will probably want to hear a little bit about from Australian Super, and that is over the past few months or so, Australian Super has copped, probably fair to say, a lot of criticism in the press, certainly, around the approach and the tactics and the strategy of partnering up with BGH Capital to tilt at HealthScope. What's driving that approach for Australian Super? What's behind that? We don't need to get into the specifics of HealthScope clearly, but what's driving the strategy and the thinking at an Australian Super level?
Yeah, look, it's everything we talked about. It's building those capabilities, the maturity of the system. So if we look at Australian Super, this journey really started about 6 years ago when we started to think about how do we think about internalisation and understanding where we were going to grow to. What was the appropriate platform for us to do what we want to do? And as an organisation, we're a single-purpose organisation. We are investment return focused for our members. And so the thinking was, okay, with this amount of money coming in, what is a fit-for-purpose platform? And so we were thinking largely, or I was thinking largely about domestic equities. And one of the unique aspects we had at Australian Super was that we were agnostic towards equity. So we didn't make that sort of somewhat artificial divide between listed and unlisted equity assets.
Yeah, that's right. That's unique, isn't it? Because in Australian Super, private equity sits underneath the equity strategy.
It does. And look, we take the view that, valuing a company is the same. I mean, the process you go by to analyse what is the value of a company from an investment perspective is the same. The administrative sort of way that you hold that investment is slightly different, in the timeframes and the liquidity issues. But the fundamental thing we think we do well, which is analysing an investment, and that's why we're agnostic between listed and unlisted. So as we built that platform out, we actually started our co-investment program back in 2014, 2015. And HealthScope was our 41st co-investment deal. But it was just that the first 40 were overseas. So no one paid much attention to it. So we'd built a very strong platform, and I think within the private equity world, people understood what we were doing in that co-investment space. I mean, HealthScope was more a co-underwrite in the sense that we were part of the initial consortium. But we'd been telling people for a long time that this was our line of sight and this is what we wanted to do. It shocked a few people when we actually did what we said we were going to do, which is par for the course at Australian Super, I think. Is
it a reflection, Sean, on the state of the listed market, the approach that Australian Super is taking in this particular area, in this context? Is it a reflection on where we are as a marketplace? Are we lagging behind where we ought to be from a productivity, business competitiveness point of view in our listed sector? Look,
it's hard to say where we sit globally versus every other listed market, other than the sense that we know the big trends. I mean, there is obviously that shift towards unlisted investments, which we think we can play by being agnostic to. But there's no doubt this trend of short-termism is there. I mean, whichever way you cut the data, there is a view that sort of short-term behaviour is probably leading to suboptimal outcomes. So if we think that we can create more value by sort of, or there's a value arbitrage by taking a longer-term view versus sort of where the market's pricing something in the short term, we're going to take advantage of that. And that's the beauty of the platform that we've created, that we can actually do that in our drive to generate better longer-term returns for our members.
Deanne, super funds, of course, are recognised, I think, for the unique position that you all occupy in the marketplace, and that is funds that have an enduring capital inflow. There will come a point, of course, where outflows start to become more dominant than inflows, but that's quite a way down the track from here. But super funds have the luxury, of course, of thinking long term. Is that the way, as a CEO, is that the way you set strategy at a whole of fund level for a fund like First State?
Absolutely, and it is one of the unique benefits of the super system and the big super players is you have to think long term. And so it isn't just about that, looking at that from an investment perspective, it's absolutely looking at that from an overall strategic perspective. So we've just gone through, for example, our most recent round of looking at our strategy and reviewing that, and we looked 10 years out and then came back into, okay, what does that mean for the next couple of years? And then specifically, what does that mean for 2020? So that's absolutely the way that And you have to, because ultimately we are the trustees of members' money that are retiring. Some might be retiring in the next 10 years, but some are retiring in 20 years, 30 years, 40 years, and you've really got to take that into consideration.
Do you think super funds are a better reflection of community and societal values than other institutions that we have around us, perhaps even including government?
I'm not necessarily going to make the comparison to others. What I would say is that certainly if I look at a fund like First State Super, we certainly, when you look at our member base, we've got a lot of teachers, nurses, police officers, firefighters, public servants. So, and we stay very close to those. And we are an equal representation board with half employer and half union. And so you actually do get a lot of input into community expectations and where they're at. And certainly I spend a lot of my time out with members, talking to members. And so that actually puts us in a very unique position to really understand, I think, community expectations. That is not to say it's perfect, by the way, and you can certainly miss things, but certainly if I think about our member base, it does give us that perspective.
Sam, the Royal Commission that played out during last year into banking and financial services obviously had a lot to say and drew many conclusions about different aspects of our financial services sector, and I think it would be fair to say, as we sit here today, that industry super funds in Australia have been, in broad terms, net beneficiaries of what played out during 2018. The governance model, though, that Deanne's touched on around industry super funds is always a contentious one. Does it hinder the approach that you guys take at a day-to-day level? Does it get in the way? Are there vulnerabilities around that governance model that impede what it is you would like to do? Or, in fact, is that governance model actually turbocharging what it is you seek to do in the market?
I trust you're referring to the governance model of the number of trustees around the table.
Yeah, exactly right.
There are various models. Anyway, they're not all uniform. First State Super, I think, has an equal representation model, 50-50 between sponsoring employers and sponsoring union. Host Plus, on the other hand, has the 1/3 employer, 1/3 union, 1/3 independent model. Both of those models are outstanding models. Look at the history of the superannuation industry, look what we've been able to achieve with both of those models. What's important here is that when vested interests around the table all have their money in the same pot, those vested interests disappear.
There's alignment.
There's alignment.
Let's turn now to a discussion about where we are from an economic perspective, a markets perspective. Sam, you touched on this a moment ago, and many of you in the audience today will likely have seen some of the commentary, in fact, in today's press referencing a discussion with Sam over the past couple of days where he talked about creating assets in order to continue to fuel the pipeline of opportunities to deploy those vast amounts of capital that sit within the system. What are your perspectives, Sam, on what needs to change in order to make that happen? It's one thing to talk about it, it's one thing to acknowledge the opportunity, but what actually needs to change in order to make that happen?
I think the uppermost thing that needs to change today is that we have to stop thinking that we are in a storm, that we need to go back to some kind of normal level of yesterday. This is the environment that we're in. We're likely to be in the environment that we're in now forever. Right? There is no storm. You have to keep investing in the environment that you have at any point in time. Right? The reality is that those other days, they're gone, and we're not going back to them. And the more people wait by the sideline, waiting for those other days to come back, the longer it's going to take to face reality.
Can governments and regulators, central banks do anything about that, do you think?
They're part of the root cause. Right? Everybody's waiting to go back to 2 to 3% inflation, waiting to go back to interest rates at a particular level, waiting to go back to some normal world that's gone. We're not going to go back to those to that part of the world. It's gone.
And is technology, you think, underwriting that permanency of the shift?
Right, so in my view, technology is massively deflationary, we know that, and it is the root cause as to why we don't get inflation anywhere in the world. And so the solution for central banks around the world is simple, in my view. If you want to generate inflation, switch off technology. Therefore, well, if we're right...
We tried to start by switching off your microphone. That didn't work. Still ended up with a microphone. If we are right, that technology is the root cause of no inflation, then it's futile. And you can see it around the world. Central banks have got negative inflation. Unemployment is falling in different parts of the world, and you still don't generate inflation, right? And so if that is the new world that we're in, then we may never get inflation again. How do you deal with that, Sean?
Yeah, look, I agree. The King Canute strategy ain't going to work. I mean, and so you've got to think about those long-term secular trends. I mean, we know that technology, it is genuinely different this time. We've seen that from the internet to digital. We're living that, and we have to be aware of it. So every company has to have a digital strategy. And then similarly, capital formation. We look around the world at just the ease with which capital has been formed, and that isn't going away as well. So they're two such big secular trends that any sort of issue of the short-term cycles really, again, from a long-term perspective, aren't the issues. It's those longer-term secular trends which make this a very interesting time.
Yeah. And internalisation, I should say, of strategies within super funds is clearly another big shift that we've seen occur over the past decade or so here in this market, and you could argue it's played out fairly comprehensively in some asset strategies, but in the private markets context, Sean, how do you see the future in a context where there is a lot of discussion about whether or not internalisation of programs in private markets is the right thing to do or the wrong thing to do, and the challenges that exist around it?
If we just separate private markets for the moment, if we think about our broader internalisation strategy, it was really a discussion of what can we do that we think we don't have to pay a variable cost for, that we can do on a fixed cost basis and build off our platform. So we were able to go around and sort of identify a number of things. So listed Australian equities was an obvious one for us. You know, you think back 15 years ago where people were still paying 70, 80 basis points and that came down. Well, we were able to bring, on a fixed cost platform, bring that down substantially. And what that gives us is a greater sort of, I suppose, wallet to then go and sort of partner with people and use our MER budget sensibly with the people or the strategies that we think will ultimately be price takers for. And so that's really the strategy. It's getting that blend right to say, well, what do we think we can do internally that matches our culture and we think we can sort of resource with appropriate professionals, and what then do we want to go and sort of partner with externally to sort of increase the overall returns. So the strategy's really been about greater flexibility and optionality.
Yeah. And Sam, at a Host Plus level, do you see it the same way? Do you adopt a different approach when it comes to this question of internalisation?
Well, we have a different view, but the ambition is the same. So let me agree with what Sean has said, and that is we need to spend our MER budget sensibly, and we would like to have pay lesser fees, because a reduced fee is a riskless return to our members, period. But there are two ways of doing it. One way is the way Australian Super has done it, and the other way is for me to ask the investment management community to give me the equivalent fee discount. Either way, you lose out. So you figure it out for yourself, right? You either get terminated, Sean's way, or you survive and you give me a fee discount, my way. Submissions can be sent to me later.
It's good to put it in black and white terms.
It's okay, if we needed controversy for tomorrow's papers, that's it.
So am I the bad guy in this?
I think, if I can, I think what both Sean and Sam are saying, if you look out 5, and I don't know, is it 5 years, is it 7 years, it might be 10 years, and you think, well, where is this market going, and therefore what does that mean in terms of the way different funds will choose to invest? We believe that there's actually going to be a handful, dozen of really large super funds. There will also be very niche funds that have very clear segment or differentiation to their segment, by the way. So I'm not just saying that they'll just be the large funds. But to actually survive and have a ticket to play to being one of those large funds, it will be about top performance, using your scale to drive down fees, really good member experience, and really good governance. And it is that simple in terms of what you need. The funds will choose different ways to achieve that, but those 4 things will be in common for each of the large players that really shine in this next decade.
And that's really what we want. We want a diversity of approach. There shouldn't be one size fits all to this. I mean, as you talked on earlier, there's an incredible amount of money that needs to be sort of allocated. And what we really want is diversity. We want diversity of approaches, diversity of thought, because that's what you really want out of competition. And that, hopefully from that creativity sort of comes and we get better outcomes. I mean, that's a policy standpoint. Obviously, we all sit here with our own funds and we think our way's the best and we'll sort of push that on. But if you think it on a broader policy, we want diversity. And we probably didn't have that in the noughties. And we talked on earlier about the maturity. 10 or 15 years ago, there was a sameness about the industry. Yeah. As we mature, people are starting to branch out and have the maturity to do things differently, and that's great.
Yeah, we mustn't forget, of course, that for the $3 trillion that we talk about in the system at the moment, we're really only talking about a system that's 25 to 30 years old, essentially. And Sean, in a prior discussion with me, you said that if you actually take a macro perspective on this, it's a little bit like when you compare and contrast where we are today to where we started, handing the keys to a Ferrari to an 18-year-old and letting them loose.
I think that was more about the industry in about 2000. And my analogy was like giving, what does an 18-year-old want? He'd love a Ferrari. Well, I know my 18-year-old would, but you wouldn't want to give him the keys because he'd crash it. And I think that's what the industry was a bit like in the noughties. We just grew so quickly. And I think that, you go back to that time where it was all about agency. So we had, I think, 150 Australian equity managers. I mean, that was just crazy. I mean, there weren't 150 stocks that were worth investing in. Everyone who hanged their shingle out could be a private equity operator or a venture capital sort of firm. We've matured from that, and people have built track records and have built better capability.
Yeah.
We've created an environment where there's an incredible amount of capital. What we want are people knocking down our doors and sort of giving us really good options to sort of allocate that capital to. So no, I mean, the challenge is not to make it a finite pool, is to sort of increase the number of opportunities that actually exist here in this country.
And Sam, what would you like to see this industry in this room and out there back in the market doing more of to create and be a part of establishing that innovative pipeline of new investable opportunities?
Well, this room represents private capital in essence, right? And, we all recognise that private capital, whether it's private equity or other forms of private capital, there has been a historical way of doing things. Right? The way you raise capital, the way you have fee structures or vehicle structures, but that's not set in cement. And there are lots of opportunities to be innovative. For example, and I haven't spoken to Sean about this, it's always nice to have policy on the fly, right? but if Australian Super keeps taking companies private, you might want to create a vehicle at some stage that in essence holds companies private forever. But that's not the private equity model. What about companies that go through from venture capital through to private, through to pre-IPO but never list? Where do we house those? Why can't we have models that look after that? We may never want to list those, ever. And so we need to be innovative about how we, do we create a private exchange, in want of a better term, that has a group of sovereign wealth funds and large Australian pension funds and others that contribute capital to it for the sole purpose of keeping those companies private. So there's lots of ways, and how do we deal with that?
Yeah, and that's something clearly that an industry like this could be turning its mind to as part of putting in place solutions to some of the major challenges.
And what I'm saying is that if you persist with the old model, let me raise capital, invest, harvest, get my fees, raise the next fund, that may be a short-sighted approach.
And I think it'll be a short-sighted approach too if you just think domestically as well. I mean, go to where the money's going, and the money's going offshore. So you've got to build your models, and you've got to be at least thinking through that and saying, okay, how are we going to sort of be relevant for that stream of money? I mean, you still might do well domestically, and yes, we might create opportunities, but surely it's about sort of getting your model right and sort of getting offshore, and that has benefits for Australia as well.
Is that about, Sean, growing Australian businesses into global markets like the immediate previous discussion on this panel where we talked about growing into China, or is it about actually deploying primary capital into offshore markets?
What about bringing international companies to Australia? I mean, if we create such an incredible environment where you sit back and say, look, just the whole ecosystem is solid. We've got a great legal system. We've got lots of capital. It's not a bad place to live. It's relatively safe. Why aren't we having that discussion of saying, well, why can't there be more capital based here in Australia, especially in this regional context?
Yeah. I want to spend a few minutes shortly, Deanne, asking a little bit around what occupies the mind of a CEO of a major super fund in the context of that forward-thinking strategy that you touched on a little bit earlier. But before we get there, we do have, unsurprisingly, quite a few questions from those in the audience this morning. I'm going to pick out a couple of them and throw these to my panellists. The first one is that yesterday Wendy Norris from the Future Fund spoke a lot about the process of selecting managers, looking at the reward structure that sits between managers and the investors and the alignment of those structures. Do you think that institutional investors like super funds need to review and reward their own people better?
I'll let the CEO answer that. That
seems fair. Deanne?
Look, I certainly think as you're seeing the maturing and the system getting more sophisticated, there is no doubt in terms of attracting and making sure you've got the right talent and the right capabilities that you've got to pay well and pay fairly. What I would say though is that doesn't equal what the private equity world is necessarily paying today, for example. I think you've just heard from the panel the focus on fees, the focus on things like remuneration will be critical. So I don't necessarily say it's one or the other. I think it is about being paid fairly. But also, I think certainly from our perspective, if you look at those that are part of the First State Super team, it is well beyond just REM when you think about what's the benefit of working at a super fund. That's very purpose-driven, great culture, great overall employee proposition. But also looking at things like flexibility and that side of things. So for us, it is about attracting the right talent, but not just those chasing the top REM dollar.
Sam, there's a question here which I might pose to you, and that is that super funds have been attracted to energy infrastructure for some time now as a relatively low-risk asset strategy. But how much thinking is going into the looming technological disruption that might play out in that part of the market?
In energy? Well, an incredible amount of thinking, ultimately. If your question is specific about energy generation, for example, and there's lots of forms of energy markets, right? The reality is that here and now, 3/4 of the world's energy needs, 75% or more, are coal-fired power station generated. Right? We need to divorce that from our desire that it's zero, but the reality is that that's not the case, and a fast transition to a zero carbon world is not going to happen, not tomorrow. And so you could see the future, but you don't want to go into a market timing event, which means taking action today for something that won't happen for some time. And so there's that type of activity happening in the background. And then there's proactive investments. It's another way of dealing with change in a particular industry. So for example, if you want to be proactive in that space, you can invest in renewable energy technology, or you can invest in technologies that are yet to be invented, right? Earlier stage technology. One that Host Plus has recently invested in, fusion energy, for example, is still in the labs, right? So you need to think about that type of long-term structure. That often gets lost in the argument about, why are you holding this asset or not holding that asset?
Yeah. And Sean, there's a question which I think is directed squarely at you around, it builds on, I guess, part of the discussion from a little bit earlier in this panel. But do you believe the governance structure of listed companies here in this market is fundamentally broken?
Not broken, but it certainly needs sort of a bit of a rethink. And it's this perennial discussion of, who are we there to serve? And it was addressed in Hayne and the whole discussion of, and even this broader global theme about, is it about shareholder maximisation? And if so, which shareholders? Is it your short-term shareholders that are on the register for a nanosecond, or your shareholders that are there for maybe longer term? And I think what's happened historically, it's those short-term shareholders that have had greater voice and greater ear of the boards, and that's what we need to change. So we need to see boards sitting back and essentially being prepared to sort out the signal for the noise, and sort of get their alignment right for what they're trying to achieve. And if they do want to run the business for the long term, articulate how they're going to do that, and make sure they're talking to the right shareholders.
You engage quite extensively as part of your role with the listed market. Do you get the impression that change is underway?
I think there's a lot of willingness, but there's still a lot of uncertainty, because we're again in that trend. We've been so stuck in the way of who boards have listened to, that they're still trying to get their heads around, what is the direction we should be setting? And it's still very unclear. There's some I've had this discussion a lot in the last 6 months. There's some very talented, very capable directors who are still uncertain themselves. Is our objective about sort of our duty to the company, or is it to shareholders? If so, which shareholders? So we're still trying to work our way through that. But look, you'll see it will change. It will change over time. And to Sam's point earlier, we can see where the end point will be. There's just going to be a bit of a rocky road getting there, I suspect.
Deanne, back to you. A question here about social responsibility, and I should take a moment to acknowledge and congratulate Deanne, First State Super, along with Hester, overnight. Some of you may or may not be aware, but overnight in Paris. First State Super and Hester were acknowledged as a group of 6 Australian super funds as being world-class responsible investors. So congratulations on that, a fantastic achievement. Fantastic to have a group of Australian funds featuring prominently on that list globally. The question here for you is, given the role that super funds play in a community and societal context, is there an obligation on super funds to play a prominent role when it comes to influencing social issues, in the same way that, for example, some listed companies, where we've seen over the past few years or so now, take fairly public positions on a range of societal challenges?
The way I describe it is, first and foremost, and the sole purpose of superannuation funds is to provide the best possible retirement for their members. And I think that you'll get a sense from each of us that is the primary responsibility of a super fund and must be paramount to all others. We take a view, though, is on your way to achieving that, if you can actually do well for the community that your members represent, then that's actually even better. And so when we're looking at opportunities, we're certainly looking at how do you actually get the very best return possible. But if it can actually have a positive impact on the community, that's even better. And that's why we have invested. So we were talking earlier about creating ideas. So we've, for example, owned the Bankstown Airport, but at the Bankstown Airport, actually we're just beginning to create the Polair headquarters. And the police are obviously, and the air police are obviously one of our biggest, or not one of our biggest, but certainly in our member base. So we're actually able to do that get a great investment return, but actually also invest back in that community. And that, for me, is actually a win-win. And so, but you've got to have your eyes out looking for that type of thing as well. And that is the sort of fund that First State Super is, and we've certainly been a top performer through that as well.
Yeah. Sam, there's a question here for you. A lot is said, of course, of Host Plus's strategy in the venture market. If you believe the papers sometimes, you would be mistaken for thinking that Host Plus is perhaps the only institutional investor allocating capital into venture in Australia, but that's a different issue. But interested in your thoughts on, and the question here is about whether or not you're worried about the disruptors coming into the supermarket.
The disruptors being the ones that claim that they are addressing a particular segment of the member base, like millennials,
yes.
We invest for you.
We won't name them, but yes, they're the ones.
Right. Well, are we worried about them? Never underestimate anybody on this planet. There's a start, right? However, having said that, the super industry, quite rightly, has a governance structure around it, that there are legal requirements. You can't just set up, the barriers to entry are high, right? You can't just set up a fund tomorrow. You need licenses, you need trustees, you need investment governance arrangements, you need policies, you need diversification, you need scale eventually to survive. If they can meet all of those requirements to play, then bring them on. And if they do meet all of those, then I expect them to be no different to the people sitting here. Eventually, they'll be invested in all of the things we are.
Yeah. Okay. We do have just on 5 minutes left now, so I want to spend the balance of the time just hearing some reflections from each of you about what's worrying you about the outlook. We know there's a lot to be optimistic about, and we actually spent some time yesterday, perhaps except for the session with our economists, where we probably left that session wanting to slit our wrists a little bit. But otherwise, there is generally an upbeat outlook, certainly pervading our industry here in this market. But I'm interested, Sean, and I might start with you, and then Sam and Deanne in turn. What do you see in the crystal ball for the future, and what, as a message to the private capital ecosystem here in this market, do you think we should be thinking about?
I think I touched on it earlier. It's just this incredible opportunity we've got. We've created an incredible base of capital, and there's a lot of talent out there. And I suppose from an industry standpoint, we want to just make sure that we get out there and, we utilise that base. There's an incredible amount of talent coming through. The university systems are very good at sort of sending us very good and capable graduates that can work in this financial services industry. So it's really just optimising it and maybe taking away some of the negatives that aren't as relevant to sort of thinking about how we should be investing, and then taking that base and maybe taking it certainly more regional and if not more global and doing it in that partnership sort of model that I think everyone's talking and espousing to.
Yeah. Got it. Sam?
Let me just start by saying 99% of the world's assets are unlisted, right? Just think about it. So the reality is that's where the world's heading, and that's where all our investment dollars are going to be directed increasingly in the future. The community that's sitting out there, all of you, rather than waiting for investee companies to be created by other people and for you to assess them in order to invest, why don't you help them build them, right? I spend a lot of time talking to universities. Half their problem is that they couldn't commercialise anything. Why don't you help them do that? That way they can create companies for you to invest in rather than waiting for it. Try and be a little bit more innovative. If we build the ecosystems and the precincts around the universities, then we can leverage that in this country to reshape our economy.
Perfect message. Thank you. Deanne?
If I look forward, I would say a little bit what I said previously around you'll see certainly large funds with top performance using their scale to drive down fees with good member experience and good governance. For me, that's a given. I think beyond that, though, particularly for those of you today from the private markets, what I'd say is with that will come a real long-term focus. So if I think about some of the changes that will probably need to occur from a private capital perspective with the types of funds like you're seeing here, there will be a much greater focus on longer term. So it's thinking about how is value created. Is it created with imagination and creativity? Is it created for the long term and for and also looking at things like it isn't just about burning and churning. So whether that's stripping out costs, getting rid of people, making short-term profits, that will not be the focus of these big long-term players. And so really thinking about where value creation is coming from will be really paramount, I would say, together with, as you've heard each of us, we need to drive back benefits for members, and we will be looking at that in any which way we can. And so that is absolutely what you'll see continued focus on in the longer term. And the final thing that I'd say, if you really go out, say in 10 years' time, there will also be much more focus on the retirement side. So the system is still relatively young. It's still much more accumulation focused. And yes, we've had lots of conversations about retirement, and it's got bogged down in conversations around SIPR and annuities. But actually, as more of this money heads into retirement, the super funds will naturally adjust the way that they are investing and what the products and the funds will look like. So I'd be thinking through what that might mean as more money sitting in retirement and less in accumulation as well.
Yeah, really good point. The value creation point is something that we're going to be exploring, in fact, later this afternoon in a separate discussion, Deanne, so very timely of you to mention that. But we're out of time. We could keep talking for hours with our panellists, I'm sure, but I think you'll all agree it was tremendously insightful to hear some perspectives from our three speakers this morning. You're all a very important part of the future of the Australian superannuation system and through that, the Australian community. So thank you very much for being generous with your time and sharing some of it with us this morning. Please join me in thanking our three guests.
Thanks, Esther.